In this video, I'll be showing you a powerful indicator on TradingView, and then I'll teach you a precise trading strategy using this indicator, so make sure to watch until the end. To add this great indicator to your chart, click on Indicators, then search for FX Sniper T3 CCI, the one created by H. Potter. Here it is, and as you can see, it's now displayed below the chart. This is an oscillator, and you'll notice the histogram moves above and below the center line, which is 0. First, let's go into the indicator settings and set the CCI period to 35, which will help filter out noise from the chart. Next, in the Style tab, we'll change the histogram to columns and set the green color's opacity to 100% and do the same for the red color to make the indicator more visible on the chart. This indicator measures momentum, helping you identify when there's strong upward or downward momentum so you can make better entry and exit decisions. When the histogram goes above the center line and turns green, it indicates that the upward momentum is stronger than the downward momentum, suggesting the price will likely rise. Conversely, when the histogram drops below the center line and turns red, it shows that the downward momentum is greater, indicating a potential price decline. However, if you rely solely on these signals, you'll often face false signals, especially in flat markets or during pullbacks. Now, I'll teach you a strategy that filters out many false signals, so you can focus on signals with a higher chance of trend reversal. For this, we'll add 3 exponential moving averages to the chart. Click on Indicators and search for ribbon, add the moving average ribbon, which is a built-in TradingView indicator. Now go to the settings of ribbon and in the Inputs tab, remove 1 because we'll only use 3 moving averages for this strategy. Change all 3 to exponential moving averages, EMA, and repeat this for the other 2. Set the length of all 3 EMAs to 77. The first one should be based on low, the second on HLC3, and the third on high. Now, with these settings, we've created a ribbon that can help identify trend changes, and it can also act as support or resistance. When the price is below the ribbon, the market is trending down, and the ribbon acts as resistance. When the price is above the ribbon, the market is trending up, and the ribbon becomes support. Now that everything is set up, let's see how to trade using this strategy. If the price moves from below the ribbon to above it, and a candle closes above the ribbon, and the histogram turns green at the same time, this is a bullish signal indicating a possible uptrend, but we need more confirmation, because if the price is in a range and moving flat, we might get repeated closings above and below the ribbon, and we don't want to get trapped in such conditions, as this can lead to many false signals. So when we get a candle closing above the ribbon and the histogram turns green, it's an early signal and we need further confirmation before entering the trade. As mentioned, when the price is above the ribbon will act as support. In this strategy, we wait for a pullback to the ribbon. When the price pulls back to the ribbon, we mark the high of the previous swing high. If the momentum is strong enough to start an uptrend, the price shouldn't go below the ribbon and the price should close above this level, forming a higher high. As you can see here, a candle closed above this level. At this point, we have a higher chance that the market is shifting to an uptrend and the ribbon will likely hold as support. Practically, we would enter a long position here when the new candle opens. The stop loss is placed below the ribbon since we know the ribbon should act as support, preventing the price from dropping further. As you can see, the price did dip to the ribbon but didn't break below it, and then it advanced significantly, making our position quite profitable with the price rising to this level. On the flip side, when the price closes below the ribbon and the histogram turns red, it's an early signal that a downtrend may be forming, but we need more confirmation before entering a short trade. Similarly, we wait for a pullback to the ribbon. If a downtrend is indeed forming, the ribbon must hold and the price should not move above it. When the price pulls back to the ribbon, we mark the low of the previous swing low and wait for a candle to close below this level. As you can see, the price declined but didn't quite reach the previous swing low, and then it advanced again, testing the ribbon. Now, we mark the low of this new swing low and wait for a candle to close below it, which happened here. At this point, we could enter a short position when the new candle opens, place the stop loss above the ribbon, and as you can see, this signal was very profitable with the price dropping to this level. Please note, while this strategy is quite accurate and combining 4 indicators with price action principles helps you spot high probability trade setups, it doesn't guarantee that false signals won't occur. Unfortunately, this is unavoidable. No strategy is perfect, and losing trades are part of the process, so it's essential to manage your risk properly. A great risk management approach is the 1% rule, which works well with this strategy. I've made a complete guide on it, and you can find the link in the description. I highly recommend you check it out because without proper risk management, it's difficult to become a successful trader. That's all for today. Thanks for watching the video. If you have any questions, feel free to ask and leave a comment. I'll get back to you as soon as I can. If you haven't subscribed yet, make sure to subscribe and hit the bell for notifications of new videos. I'll see you in the next video and wish you the best of luck in your trading.